So here to share more insights on how to navigate these issues is Jeremy Schneider. He is the founder of Personal Finance Club. Good morning, Jeremy.
Good morning, Trinity.
Thank you for joining us. I know it's bright and early there on the West Coast, so we appreciate you joining the show. So inflation is affecting everyday spending, as you know. So how can people best manage rising costs and essential areas when it comes to groceries, utilities, housing, like rent?
Yeah, well, inflation has come down a lot. It's actually down to about 2.4% right now, and you hear a lot about bringing grocery prices down. But I think consumers have to be realistic that prices aren't likely to go down. In fact, lowering prices is actually bad for an economy. Deflation would mean basically a shrinking economy. And so as an individual, what we should really be focusing on is raising our income to at least meet and keep up with inflation. So you can use that as like a negotiation tactic. If you're getting a raise at your job, say, hey, my pay hasn't even kept up with inflation, so I'd like an inflationary raise plus any raise that I have due to like a increase in my workload.
And you know, while interest rates have been dropping lately, rates are still affecting credit cards, loans, mortgages. What strategies should individuals use to manage their debt effectively?
Yeah, with debt, the rate has a impact, but what the bigger impact is generally the principal. And so while it's important to look at these macroeconomic moves like what rates are doing, it's more important to focus on paying down your own debt. If you have credit card debt, the difference between 20% and 24% isn't really your problem. The problem is you got to pay off that debt. So it's important to be hyper-focused, take all your extra income, throw it into that debt, get debt-free, build an emergency fund, then you can start investing. That's kind of your financial framework for improving your own personal finances.
And you know, we are living in a very complicated time right now, especially as we got the election results this morning. It's projected, obviously, President Trump will be the next president of the United States. So how do you think that people should adjust their portfolios during an uncertain market conditions and potential market volatility?
Well, I'll tell you personally exactly what I'm gonna do with my portfolio in response to all this different volatility, and that is nothing. In fact, if you look historically, the market doesn't really care who sits in the Oval Office. If you look at a 60-40 portfolio of stocks and bonds over Democratic presidencies, it's about 8.4%. Over Republican presidencies, it's about 8.2%. So it's very, very close. And we don't expect any sort of changes based on who's in the office. And so I'm doing nothing. I'm buying and holding. I expect volatility, but I'm going to ride that out and appreciate the growth of the entire market.
Smart places do you recommend that consumers should park their cash in today's environment, such as high-yield savings accounts or treasury bonds?
Yeah, I'd say you should only have really enough cash to have your emergency fund. So I actually keep relatively little cash, about 3 to 6 months of my expenses. A high-yield savings account or a money market fund is perfectly fine for that. Beyond that, I put my money into the market. I buy and hold index funds. I buy broad market, low-cost ETFs and index funds, and I ride out the volatility. And so while I do keep a little bit of cash in my account just to cover any unexpected expenses, most of my money is in the market, letting it ride, getting those those bigger gains long term.
And what should individuals know, especially approaching retirement? How should they safeguard their savings that they have in those 401ks or their retirement savings accounts?
It's something you shouldn't be doing that's responsive to the market. If you are trying to make moves based on what you see in a presidential election or with rates, you're going to be much more likely to hurt yourself than help yourself. A better strategy is to have a slow progression towards bonds as you age. Generally, once you're about 40 or 45, you want to take 1% or 2% per year off the table out of the stock market into the bond market. That way, when you're more like 65, 70, you're going to have income-producing bonds that are much less volatile when these things change, and you can basically live off that income. But you want to do that slowly as part of your plan, not in response to what we see in these macroeconomic conditions, whether it's elections or rates.
Jeremy, briefly, we have about 45 seconds left here. What are some viable side hustles and remote opportunities, and what tax considerations should people keep in mind?
Side hustles have become much bigger forms of income. There's more 1099s now than there ever have been. I'd say for you though, primarily look at where you want to be in 5 years. Make sure your primary career is growing. I wouldn't just rush out to drive Uber and think that's going to be the best finance for you. So I'd say make sure you're growing your career. But if you want to start a business, whether it's dog walking or consulting or landscaping or contracting, it's a great way to build some extra income and maybe even be your primary source of income.
A lot of key takeaways right there, Jeremy. Thank you so much. Again, Jeremy Schneider, he is the founder of Personal Finance Club.